Did you know Warren Buffett recently sold a staggering $10 billion worth of Apple stock? That's right, the Oracle of Omaha is making waves in the market, and it's got investors buzzing. But here's the real shocker. Buffett's not just selling. He's also scooping up shares in some surprising companies. Today we're diving deep into Buffett's latest moves and uncovering the game-changing lessons hidden in his strategy. You'll discover why these decisions matter and how they could reshape your own investment approach. Ready to think like a billionaire and potentially boost your portfolio? Warren Buffett's recent moves in the stock market have left many investors scratching their heads. The Oracle of Omaha, known for his long-term investment strategy, has been selling shares of Apple, a company that's been a cornerstone of his portfolio for years. But why would he sell when Apple continues to dominate the tech space? Let's take a closer look at what's happening. Buffett has significantly reduced his holdings in Apple, which previously made up nearly 45% of Berkshire Hathaway's portfolio. This decision has raised eyebrows, especially considering Apple's strong performance in the tech sector. Buffett has also been trimming his position in Bank of America, another longtime favorite. You might be wondering, isn't this the opposite of Buffett's famous buy and hold strategy? Well, yes and no. To understand what's going on, we need to consider value investing, the core of Buffett's investment philosophy. Value investing focuses on finding undervalued companies with strong fundamentals. Apple stock has been on a tear recently, reaching new highs and pushing its valuation to levels that some analysts are calling overvalued. This is where Buffett's value investing principles come into play. If a stock's price rises above what Buffett considers its intrinsic value, it might be time to take some profits off the table. The same logic applies to Bank of America. The financial sector is facing challenges, including unstable interest rates and economic uncertainty. These factors could be influencing Buffett's decision to reduce his exposure to financial stocks, which have traditionally been his preferred investments. So what does all this mean? Is Buffett losing faith in these companies? Not necessarily. Remember, Buffett's strategy isn't about short-term gains or losses. It's about making sure every dollar invested is working as hard as possible for the long term. By selling some of his Apple and Bank of America shares, Buffett isn't abandoning these companies. Instead, he's likely reallocating resources to ensure his portfolio remains balanced and aligned with his value investing principles. It's a strategic move that reflects his cautious approach to investing, especially in sectors that have seen massive growth and could be nearing a peak. This brings us to an intriguing question. If Buffett is selling shares of these tech and financial giants, what opportunities is he seeing elsewhere in the market? What potential gems has he uncovered that align more closely with his value investing strategy? Ever wonder what Warren Buffett sees that others miss? The Oracle of Omaha's recent investments might surprise you. He's not chasing flashy tech stocks or following the crowd. Instead, Buffett's quietly building stakes in companies that many investors overlook. Let's peek behind the curtain and see what Buffett's latest moves can teach us about smart investing. Buffett's Berkshire Hathaway has been busy, and one eyebrow-raising addition is Occidental Petroleum. He's invested about $45 million, pushing Berkshire's stake to 28%. That's over $1.13 billion in this energy giant. Why? Occidental's price-to-earnings ratio of about 10 makes it look like a bargain in the energy sector. Plus, it reported $4.8 billion in free cash flow last year. For Buffett, who loves companies that generate solid cash, Occidental hits the sweet spot. But that's not all. Buffett's also eyeing SiriusXM, the satellite radio company. Despite its stock dropping over 60% in the past year, SiriusXM is still churning out cash. In just 9 months, it generated $1.3 billion in operating cash flow. This financial strength, hidden beneath a struggling stock price, is exactly what Buffett looks for. The third piece of Buffett's puzzle? VeriSign, a domain name registration manager. Buffett recently added 234,000 shares worth about $45 million to his existing stake. VeriSign's appeal? An impressive 60% operating margin and $7.3 million in free cash flow over the past year. That's the kind of efficiency Buffett loves. So what's Buffett's strategy here? Think of it like finding a luxury watch at a garage sale. The value is there, even if others don't see it yet. Buffett's looking for solid businesses that are temporarily underappreciated, focusing on strong cash flow and undervalued status. This approach is classic Buffett. He's not interested in companies making headlines, but in those generating real money while being overlooked by the market. It's a strategy that has served him well over the years. While we can't predict the future, Buffett's track record suggests he might be onto something. These companies have strong fundamentals and are generating significant cash. If they maintain this performance and the market eventually recognizes their true value, the payoff could be substantial. It's a reminder that sometimes the best investments are hiding in plain sight, waiting for a savvy investor like Buffett to uncover their potential. Warren Buffett's recent investment moves are painting an intriguing picture of his market outlook. But these decisions might be signaling something bigger about the economy. Let's zoom out and see what the Oracle of Omaha might be predicting for the future. Buffett's recent actions in the stock market have raised some eyebrows. He's been trimming his position in sectors that have experienced massive growth, particularly in tech and finance. This cautious approach seems to contradict the current bullish market trends. So what's driving Buffett to swim against the current? The tech sector has been riding high, with companies like Apple reaching new valuation peaks. Some analysts are even labeling these tech giants as overvalued. Buffett's decision to reduce his Apple holdings suggests he might be seeing storm clouds on the horizon. By locking in profits while stock prices remain high, he's potentially protecting Berkshire Hathaway from a market correction. The financial sector, long a favorite of Buffett's, is facing its own set of challenges. Unstable interest rates and economic uncertainty are putting pressure on banks' profit margins. This explains why Buffett has been reducing his stake in companies like Bank of America. Buffett's focus on value investing is leading him to undervalued sectors like energy and infrastructure. These areas offer more stability and growth potential compared to the possibly overheated tech stocks. Berkshire Hathaway is currently sitting on a massive cash reserve of over $325 billion. This gives Buffett incredible flexibility to make strategic investments while navigating market volatility. It's like he's setting up his chess pieces, preparing for multiple possible scenarios on the economic chessboard. Buffett's actions suggest he's anticipating a potential market correction. By investing in companies with strong cash flows and solid fundamentals, he's positioning his pawns and rooks for future growth while protecting his king from possible downturns. In this chess game of investments, Buffett isn't just reacting to the current market conditions. He's thinking several moves ahead. His strategy of building a fortress of cash while making calculated moves in undervalued sectors shows he's preparing for whatever the economic future might hold. As we watch Buffett's next moves, we might just get a glimpse of what the financial landscape will look like in the coming years. Picture this: a financial juggernaut with the power to reshape entire industries at will. That's exactly what Warren Buffett commands with Berkshire Hathaway's colossal $325 billion cash reserve. But why would the world's most famous investor choose to keep so much money on the sidelines? The answer might surprise you, and it could change how you think about your own saving strategy. In a world where cash is often seen as idle, Buffett is amassing it like never before. This massive war chest gives him unparalleled flexibility to make strategic investments when golden opportunities arise. It's like having a loaded gun in a world of financial opportunities, ready to fire at a moment's notice. Buffett's approach to cash is unique. For him, it's not just money sitting idle. It's ammunition for future market battles. While others frantically try to squeeze every penny into the market, Buffett patiently waits for the perfect moment to strike. This strategy allows him to act swiftly when undervalued assets present themselves. History has proven the power of Buffett's cash strategy. During the 2008 financial crisis, when most investors were panicking, Buffett was making some of his most lucrative investments. With his sizable cash reserves, he invested heavily in companies like Goldman Sachs and General Electric when their stock prices plummeted, securing incredible returns as the market recovered. You might wonder about the opportunity cost of holding all that cash. It's like having a savings account that earns minimal interest while your friends' investments grow. However, Buffett's strategy emphasizes patience and timing. He's not interested in quick gains, he's playing the long game, waiting for those rare opportunities that can deliver outsized returns. So, what opportunities might Buffett be eyeing with his $325 billion war chest? Market corrections, economic downturns, or industry disruptions could all be potential targets. Imagine a major market correction sending stock prices tumbling. While most investors lick their wounds, Buffett would be poised to acquire high-quality assets at bargain prices. The exciting part? Buffett's cash strategy isn't just for billionaires. Regular investors can apply similar principles. While we might not have billions, keeping some dry powder for opportunistic investments is a valuable lesson we can all learn from. It's about being prepared to seize opportunities when they arise, just like the Oracle of Omaha himself. Ever thought Warren Buffett's investing wisdom was out of reach for the average person? Think again. You might be surprised to learn that the Oracle of Omaha's core principles are actually accessible to investors of all levels. Let's explore how you can apply Buffett's playbook to your own portfolio, even if you're not working with billions. Buffett's approach centers on value investing, which he describes as shopping at a discount store for high-quality items instead of splurging at a luxury boutique. This means seeking timeless investments rather than chasing trends. But how can you, as an everyday investor, put this into practice? The key is Buffett's simple rule. Price is what you pay, value is what you get. This requires a mindset shift. Train yourself to look for businesses with strong fundamentals, solid earnings, low debt, and consistent performance. The trick is finding these gems when they're undervalued by the market. To identify these opportunities, start by doing your homework. Research companies thoroughly, read their financial statements, and understand their business models. Look for businesses with a competitive edge in their industry, what Buffett calls a moat. This could be a strong brand, unique technology, or dominant market position. Remember, Buffett's strategy isn't about quick profits. It's about patience and long-term thinking. Consider his investment in Coca-Cola, which he's held for over 3 decades. While you don't need to hold stocks that long, adopting a longer-term view can help you weather market volatility and potentially reap greater rewards. So how can you apply these principles with a smaller portfolio? Here are some concrete steps. 1. Set aside a portion of your investments for value stocks. 2. Look for out-of-favor companies with strong fundamentals. 3. Focus on sectors that are currently overlooked or experiencing temporary setbacks. 4. Regularly review your portfolio, reallocating funds if investments no longer meet your criteria. 5. Cultivate patience by focusing on intrinsic value rather than daily price fluctuations. Historically, value investing has shown its strength, particularly during market corrections. When the market takes a downturn, undervalued stocks often demonstrate more resilience and tend to rebound more strongly. This doesn't mean value investing always outperforms growth strategies, but it has proven its worth over time. Remember, successful value investing isn't about vast fortunes. It's about adopting the right mindset and staying disciplined. By following these steps and staying patient, you too can harness the power of Buffett's investing wisdom. Speaking of intrinsic value, there's one principle that underpins all of Buffett's investment decisions. It's deceptively simple, yet profoundly powerful. What if this single rule could transform the way you approach investing? Warren Buffett famously said, "Price is what you pay, value is what you get." This golden rule encapsulates the essence of his investment philosophy. But what does it really mean, and how can you apply it to your own investment strategy? At its core, this principle highlights the critical difference between a stock's market price and its intrinsic value. The market price is what you see on your trading app or in financial news. It's constantly fluctuating based on supply and demand, investor sentiment, and market trends. But the intrinsic value? That's the true worth of a company based on its fundamentals, things like cash flow, assets, and growth potential. Imagine you're at a farmer's market. You see 2 apples, one priced at $1 and another at $5. The $5 apple looks perfect, with a shiny red exterior and unblemished skin. The $1 apple is slightly bruised but smells sweet. Upon closer inspection, you discover the expensive apple is mealy and tasteless inside, while the cheaper one is crisp, juicy, and bursting with flavor. This is exactly how Buffett approaches stocks. He's not swayed by the shiny exterior, high price, but looks for the true quality, intrinsic value underneath. So how can you apply this principle to your own investing? Start by doing your homework. Look beyond the stock price and dig into the company's financials. Are they consistently generating cash? Do they have a strong competitive advantage in their industry? Are they managed well? These factors contribute to a company's intrinsic value. To begin assessing intrinsic value, try these practical tips. 1. Study financial statements, focusing on cash flow and debt levels. 2. Analyze the company's competitive position in its industry. 3. Consider the company's growth potential and future market trends. 4. Compare the company's metrics to its peers. 5. Use valuation methods like discounted cash flow analysis. Keep in mind that determining intrinsic value isn't an exact science. It requires patience, research, and a willingness to go against the crowd. You might find a company that's undervalued by the market, but it could take time for others to recognize its true worth. The beauty of focusing on intrinsic value is that it can help you weather market volatility. When you understand the true value of your investments, you're less likely to panic sell during market downturns or make impulsive buys during bull markets. Warren Buffett's recent investments in Occidental Petroleum, SiriusXM, and VeriSign showcase the power of value investing. These companies generated billions in free cash flow last year, highlighting the potential of uncovering hidden value. Buffett's moves remind us that successful investing isn't about chasing trends, but about finding opportunities others might overlook. The key takeaway? The market always offers chances if you're patient and know where to look. Instead of following the crowd, ask yourself, where's the real value hiding? By applying Buffett's wisdom, you can build a portfolio that grows steadily over time. Stay tuned for our next video, where we'll explore one of Buffett's specific strategies in depth.